So when we look at world merchandise trade, down 13 to 32, you can kind of drive a truck through that range. I mean, what do we really think this range could be over the next couple of months?
We would rather characterize that as two scenarios rather than a range, because the number of uncertainties are so great. There are so many unknown factors here that it's difficult to actually call these projections. But we are seeing, in a positive scenario, a fall in trade of around 13%, which is about the same order of magnitude that we saw in 2008, 2009. So that's huge. The pessimistic scenario would see a decline in trade of around 32%. That's pretty much what we saw during the Great Depression of the 1930s over 3 years. We're seeing that in just 1 year. But that's just part of the picture. I think what is important to note is that we can recover much more quickly than we did either in 2008 or in the 1930s.
We're going to get to things like medical supplies and food supply, but you mentioned that you expect a steeper drop in sectors where the value chains are complex, so electronics, automotive products. Can you explain to viewers why?
Because these are much more integrated chains of supply globally. So we're talking about sectors like automotive sector and electronics, where components come from several parts of the world. For example, an iPhone made in Asia, it experiences an addition of about 24% in value only. The rest is parts and components that are coming from different parts of the world. So the more integrated globally a sector is, the more it's going to be affected by the disruption of the supply chains.
Director General, I mean, even before we saw this pandemic take hold and rock the world, we were seeing quite literally the rules around trade being rewritten, with supply chains being diverted, changed, shifted, obviously tariffs, the trade war between the U.S. and China, but also all of these agreements between quite a number of different countries. How does that factor in to your methodology and how you're arriving at these projections today? And what does that mean now post-COVID in terms of the rewriting of trade flows moving forward?
Well, that's a very good point, because that's precisely what is happening. I think this trajectory, this sharp decline that we are projecting, it's partly due to the fact that we were not doing great to begin with. So when we were in the last quarter of next year, trade was already decelerating quite significantly. And therefore, we are adding a crisis on top of another one. And this is one of the reasons why we have to be particularly careful in planning for the rebound. We could come back to pre-pandemic's level of growth and level of economic activity rather quickly. We could come to that in 1 or 2 years, but that would depend significantly on the kind of measures that we put in place. And one of them, I think, would be trying to avoid the kind of things that were bringing trade down, like the trade tensions, increasing import duties across the board in big markets. Those kind of things helped to set the stage for this decline that we're seeing now.
Director General, are the risks particularly high for emerging markets? I'm thinking about particularly countries that are reliant on trade more than usual for their economies. You talked about integrated supply chains and industries that need those as being an area of risk, but it seems like there are countries in similar positions.
Several. And the problem with the emerging economies is that they not only face the supply and demand shock that we see globally, but they also are very vulnerable in different ways. To begin with, their health system is not that great. They are not fully prepared, mostly, so the duration of the pandemic and the intensity of the pandemic can be pretty significant if they don't take the right measures. The second point is their social security safety nets are not that great either. They're very vulnerable. So the impact of an economic slowdown can be pretty disruptive from a social perspective. Having said that, those that export natural resources, they could experience a stronger rebound more quickly, especially if commodity prices pick up once the demand is restored after the pandemic is controlled in the major markets.